Hello, fellow investors. I'm Ben, and this is GVD Investing,
where I break down the latest stock market news, analyze stocks, and share my investing journey in hopes of making us all better investors. Wait, hold on. What? The stock market doesn't only go up? Oh man, this sucks. I should have sold all of my stocks and taken my profits. If I was day trading, then yeah, but we're not day trading, we're investing. So there's no need to panic. If you're investing in stocks for the long term, you can be certain of one thing. Your account will go down sometimes. Sometimes it'll go down a lot. That's just how it works. Stocks don't always go up. The key is learning to embrace the fluctuations and view market corrections as opportunities to buy shares of good companies while they're on sale. Don't get me wrong. It's not easy emotionally seeing your account going down, sometimes thousands of dollars in a day. It's never a good feeling. The good news is, historically, the market has always bounced back. Every single time. Sometimes faster than others, sometimes not so fast. But if you buy and hold good companies, or even just ETFs that mimic major indexes, for the long term, more than 10 years, you are almost guaranteed to make money. Significant money. The worst thing you can do is panic sell. Losses aren't materialized until you decide to sell. Stay calm, do your research, then it's time to go shopping. Basically, it's like this. Let's say you really want to buy a camera, but it just came out and it's over $600. Then, out of nowhere, you get an email that Best Buy now has the exact same camera, but it's on sale for $400. Is that a bad thing? Would you avoid buying it and wait for it to go back to its regular price before wanting to buy it? Would the sale scare you away? No. So why would you do that with stocks? And it's even better with stocks because if you buy good ones, which there are many, they will increase in value over time, unlike a camera that quickly becomes less valuable. Keep in mind, the market has been on fire since last March and just needs a bit of time to cool off. Fires don't burn forever. The market has poured some much needed water on those flames, but rest assured, the fire will burn again. In the meantime, it's time to stock up on some firewood. Since the market crashed in March 2020, there has been a lot of momentum behind high growth stocks, as they drastically outperformed the broader markets last year, and investors wanted in on the action. As a result, valuations stretched, and it became increasingly likely that a lot of those overvalued companies would see corrections at some point in 2021. That time seems to be now. As many predicted, growth stocks have been hit really hard over the past week or two. So, should you sell all of your growth stocks and move the money into value stocks or dividend stocks? I don't think so. I think there's a better way to prepare or invest during a market correction. Why do you need to choose one style of investing? You can learn from Cathie Wood and Warren Buffett. You don't have to pick one. It's not like picking a political party. You don't have to vote for one or the other. You can apply both approaches to building a solid portfolio. In fact, the reason I called this channel GVD Investing is because I like to apply all three styles of investing to my portfolio: growth, value, and dividend investing. In my opinion, I think being diversified between those three styles of investing is equally, if not more important, than being invested in different industries or tons of companies. So, in this video, the first episode of a series I will release once a month, we'll take a look at three different stocks: one growth stock, one value stock, and one dividend stock that I'm personally invested in, will be buying whether or not the market continues to drop, and plan to hold for the long term. But before we get into the stock picks, make sure to hit that subscribe button to be notified when I release more videos every week and more episodes of this monthly series. I put a lot of time and effort into researching the stocks I buy, so hopefully these videos can help you make more informed decisions when buying stocks for your portfolio, even if you just get an idea of what I look for when I'm buying a stock and the process I go through. That said, always do your own due diligence and never buy any stock just because someone on YouTube told you it's a good stock. My stock picks work for me. Make sure your picks work for you. For anyone new to investing, if you're in Canada and looking to get started investing but haven't yet, use the code in my description to get $10 for free once you've invested $100 on Wealthsimple Trade, Canada's only commission-free trading platform. Okay, that's enough with the sales pitch. Let's take a look at 3 stocks that I think are great buys during this current market correction. So, the growth stock I think is a great buy right now is GoodFood, ticker Food on the TSE. I have been investing in this company since November and will certainly be buying more now that the price has come down a bit. They are Canada's #1 meal kit delivery with more than 300,000 active subscribers, and they have recently added an online grocery delivery service to become more than just a meal kit provider. For a more in-depth look at what they do, check out my other video I released a month or so ago, where I take a deep dive into their business and their investor presentation. Now, despite being extremely fair value before the market dipped, the stock has been hit pretty hard in recent weeks. Food is down just over 10% in the last 5 days and 17% in the last month. Although, even after the recent pullback, the stock is still up over 250% in the last year. GoodFood currently has a market cap of $733 million with a price to sales ratio of 2.29, which is insanely low for a rapidly growing company. Most growth stocks have PS ratios well over 10. With Food's price to sale ratio at only 2.29, that means you're only paying 2.3 times their current revenue. There aren't many growth companies with such a low price to sales. That said, the company isn't profitable yet, but that doesn't worry me much as they are focused more on growth right now than profitability. They have a solid balance sheet too, with $104 million in cash and only $56 million in debt. Food's cash position puts them in a good spot to fund future growth. That is probably why analysts are expecting them to grow 35% this year and another 23% next year. Analysts also have a buy rating on the stock with an average price target of $15.30 and a high price of $19, while the current price is below even the lowest target. When I started investing in November, their high target was $10. That has nearly doubled in just over 3 months. If the stock can hit $19 per share, that would be almost 100% upside from the current price. I currently have 150 shares of Food with an average price of $9.83, and it's just over 5% of my portfolio, so I'm pretty comfortable with my position as is. But if the stock drops below my cost basis, I will definitely be buying more during this dip. I think this company will grow steadily for the next decade as online grocery shopping and meal kit delivery becomes more common for people across Canada. If you hold this stock for the long term, I think it will reward you with excellent returns. Now, this next company, my favorite value stock right now, is actually the stock I have been buying the most heavily in 2021. In my opinion, it's one of the most undervalued stocks on the market. Canadian Solar, ticker CSIQ on the Nasdaq. That is the only unfortunate thing about this stock, especially for Canadian investors. For some reason, you can only buy this stock in USD on the Nasdaq. It's not available on any Canadian stock exchange in Canadian dollars. I have to say, it is kind of weird having to pay US dollars to purchase stock of a Canadian company, but it is what it is. I like this company way too much to let the fact I have to pay USD deter me from buying it. Canadian Solar was founded in 2001 in Canada and is one of the world's largest solar technology and renewable energy companies. It is a leading manufacturer of solar photovoltaic modules, provider of solar energy and battery storage solutions, and developer of utility-scale solar power and battery storage projects with a geographically diversified pipeline in various stages of development. Over the past 19 years, Canadian Solar has successfully delivered over 49 gigawatts of premium quality solar photovoltaic modules to customers in over 150 countries. Likewise, since entering the project development business in 2010, Canadian Solar has developed, built, and connected over 5.6 gigawatts in over 20 countries across the world. Currently, the company has over 500 megawatts of projects in operation, over 5 gigawatts of projects under construction or in the backlog, and an additional 11 gigawatts of projects in the pipeline. Given the fact Canadian Solar is one of the largest players in an exponentially growing industry that is essential to the transition to renewable energy, which is the goal of many countries around the world right now, I simply can't understand why this stock is getting beaten down so badly. Over the last 5 days, the stock has dropped almost 20%, and it's been even worse over the last month, falling over 26% from all-time highs of $67.39. I started buying in around $57, And even at that price, I felt like I was getting a good deal. The fundamentals were good at that point. I think CSIQ is really just getting hit because of the overall pullback in the market, which, in my opinion, means this is a great buying opportunity. There definitely isn't any bad news that warrants a 25% drop in the stock price. Over the last year, the stock is still up over 100%, even after the recent 25% dip. I've been buying all the way down. I bought at 54, I bought at 52, I bought at 48. The farther it falls, the more and more undervalued it gets. After pulling back over 25%, Canadian Solar now has a market cap of only $2.74 billion. With revenue of $3.36 billion, that puts their price to sales at 0.82. That is simply ridiculous. That means you're only paying 82 cents for every dollar of revenue they make. To put that in perspective, Tesla's price to sales is over 20, which means you are paying more than 20 times the revenue at their current price. Canadian Solar's current revenue is more than their market cap. Good luck finding another profitable growth company with a price to sales of less than 1. Canadian Solar's price to earnings is ridiculously low too. They now have a PE ratio of only 13.46, which is way lower than the historic average of the S&P 500, around 20, and drastically lower than the S&P's current average PE of almost 40. Canadian Solar has been profitable every year for the last 4 years, and they now have $3.44 of earnings per share. This gives the company a lot of capital flexibility. They can use those earnings to reduce debt, fund future growth, buy back shares, or potentially even start paying a dividend, which doesn't seem that unlikely given their push to become more of a utility with recurring revenue. With $3.44 of EPS, Canadian Solar could easily afford to start paying a dividend. Another good thing to see is that CSIQ have beaten earnings expectations for each of the last 4 quarters. Other than the overall market correction, the only reason I can find that explains the recent pullback is that their revenue fell last year for the first time in 4 years. However, given the global pandemic, the revenue barely dropped and they were able to remain profitable. With Biden taking office and the expected push to more renewable energy sources, a 1-year decrease in revenue during a pandemic doesn't worry me at all. Revenue is expected to recover this year, growing around 7%, before exploding next year with 43% growth forecast. I'm not the only one that is bullish on this stock. Analysts currently have a buy rating on the stock with an average price target of $50.43, which I think is extremely low, and a high target of $71. Personally, I wouldn't be surprised at all to see this stock hit $100 by the end of 2021. That is why I have been buying so heavy over the past month or so. Canadian Solar is now one of my top 3 holdings. Between my 2 portfolios, I now have 58 shares. 33 in my Wealthsimple account with a cost basis of $54.05, and another 25 shares in my Questrade account with a cost basis of $55.75. I actively manage my Wealthsimple account, so I plan to continue dollar cost averaging while the price remains low. I'm taking a different approach in my Questrade account because I inherited some unexpected money, so I wanted to put that into a separate account, invest it, leave it, and let it grow. It will be interesting to see which approach works better, dollar cost averaging or buying in one lump sum and letting it sit. Either way, as you can tell, I'm extremely bullish on the future of this company, especially at this valuation. So, that leaves us with our dividend pick to buy while stocks are on sale. Sticking to the renewable energy theme, we'll go with one of the more reliable holdings in my portfolio, Northland Power, ticker NPI.TO on the TSX. Northland Power, an independent power producer, develops, builds, owns, and operates clean and green power projects primarily in Canada and Europe. The company produces electricity from renewable resources such as wind, solar, or hydropower, as well as clean-burning natural gas and biomass for sale under power purchase agreements and other revenue arrangements. As of March 9, 2020, it owned or had economic interest in 2,429 megawatts of operating generating capacity and 399 megawatts of generating capacity under construction. Essentially, Northland is a renewable energy utility company. Since the pandemic crash last March, Northland has been one of the most reliable stocks in my portfolio, It rarely dips, as you can see by looking at the stock chart. Northland is up almost 40% over the last year, more than that if you bought in at March lows in 2020. This stock offers good capital appreciation, all while paying a solid dividend. One of the reasons I don't own more of this stock is because it was really hard to get a good deal on it. It just kept going up for most of last year. But with the recent pullback in the market, we have seen the price come down a bit. Northland is down 8.5% in the last 5 days and almost 10% over the last month. This is the first time I've seen it fall this much since I started investing in Northland almost a year ago. If we take a look at the fundamentals, the recent dip is nothing to worry about. In fact, it seems like a rare buying opportunity. Northland is now sitting about 10% off their 52-week highs of $51.45, with a current share price of $44.95 and a market cap of $9 billion. The company is currently paying a 2.54% dividend of $1.20 per share, with earnings per share of $1.75. This dividend is well covered. The payout ratio is only 64%. The PE ratio of 25 is a little higher than I would like, but it's still lower than the market average, so I'm not overly worried. That said, the PS ratio of 4 is extremely reasonable for a dividend stock. At these prices, I would say Northland is fairly valued. If it continues to drop, the valuations could get really attractive. Northland also has good management and utilization of capital. The profit margin is 17.5%, while the return on assets is 4.81%, and return on equity is 27.61%. These are really good numbers. Overall, Northland is a solid, reliable stock to add to your portfolio. It's not as exciting as some of the other faster growing companies, but their consistent revenue and earnings growth translate well into steady stock performance. It's unlikely you'll get rich investing in Northland, but it's a great defensive stock, with considerable upside, very little risk, and a nice dividend for passive income. It would seem as though analysts agree with me on this one. This stock currently has a buy rating with an average price target of $53.79, which is more than a 15% upside from the current share price. The high target is $65, so that would be a nice 30% climb if the stock can hit that target. Northland isn't one of my largest positions, as my portfolio is focused more on growth at this point than dividend stocks. But, that said, I do plan to add more to my position, so I will likely be buying over the next few weeks if the price continues to drop. My cost basis is still way lower than the current price, so I plan to wait until it falls closer to that price, if it does. If it doesn't, I'll just keep holding as I have been for the last year. Northland is one company I could see myself holding forever, and just slowly building on over the years when the price gets to where I want it. This will be a retirement stock for me one day. What do you guys think? How are you handling this market correction? Are you going shopping too? Will you be buying any of the stocks I suggested in this video? I would love to know what you guys are buying and how you are handling this market correction. So please leave a comment down below. Well, ladies and gentlemen, I think that pretty much does it for this video. If you made it this far, I really do appreciate you. I hope you found value in this video, whether you like these companies or not. If you haven't already, please hit that like button for me and subscribe to the channel, as it really helps me out by letting YouTube know you're enjoying these videos. If you want to be notified of future videos, don't forget to hit that notification bell. Until next time, thank you for tuning in, take care of yourself, and keep investing wisely.